Welcome back to Trade Savvy Academy, your go-to channel for unlocking the secrets of smart investing. I'm Ricky, and today we're diving into a gold mine that's often overlooked: 7 long-term, consistent dividend-paying stocks and ETFs that fly under the radar. These are not your usual suspects like Coca-Cola or Apple. We're talking hidden gems that can quietly supercharge your portfolio with steady income and growth potential. Whether you're building wealth for retirement or just love the idea of passive income, this video is for you. Stick around because at the end, I'm dropping a bonus tip: a little-known strategy to maximize your dividend returns that'll leave you wishing you knew it sooner. If you're new here, hit that subscribe button and ring the bell so you never miss our weekly insights. Let's get into it and uncover these unsung dividend heroes. Why unheard dividends matter. Before we jump into the list, let's talk about why dividends, especially from lesser-known stocks and ETFs, are such a powerful tool. Dividends are like getting paid to hold a stock, and when you pick companies or funds with a history of consistent payouts, you're building a reliable income stream. But here's the kicker: everyone's chasing the same big names, driving up their prices and sometimes lowering their yields. That's where these unheard-of dividend payers shine. They're often undervalued, offering higher yields and room for growth. Plus, many of these have been quietly increasing dividends for years, proving their stability even in tough markets. According to a 2024 study by Hartford Funds, dividend-paying stocks have historically outperformed non-dividend payers by about 2% annually, with lower volatility. That's why we're focusing on the underdogs today: companies and ETFs that don't get the hype but deliver the goods. Now, let's kick off with our first hidden gem, stock number 1, Enbridge Incorporated, ENB. First up is Enbridge Inc., ticker ENB, a Canadian energy infrastructure giant that's been paying dividends since 1952 and increasing them for nearly 3 decades. You might not hear about Enbridge in the same breath as ExxonMobil, but it's a powerhouse in pipelines and energy transport, moving about 30% of North America's crude oil. With a dividend yield hovering around 6.5% as of mid-2025, it's a cash cow for income investors. Enbridge's business model is rock solid. 98% of its cash flows come from long-term contracts, shielding it from volatile oil prices. Plus, it's diversifying into renewable energy, which adds a layer of future-proofing. The stock trades at a price-to-earnings ratio of about 18, making it reasonably valued compared to its peers. Why is it unheard of? It's Canadian, and many US investors overlook it. But with a payout ratio of around 70%, Enbridge has room to keep hiking those dividends. Add it to your watch list if you want steady income with growth potential. Let's move to a utility stock that's quietly crushing it. Stock number 2, Fortis Incorporation, FTS. Next on our list is Fortis Incorporation, ticker FTS, another Canadian gem that's been paying dividends for over 50 years, earning it Dividend King status. Fortis is a utility company serving over 3.4 million customers across Canada, the US, and the Caribbean. Its dividend yield sits at about 4.2%, and it's raised payouts annually for 51 consecutive years. Talk about reliability. Utilities are often seen as boring, but that's exactly why Fortis is a great pick. Stable demand for electricity and gas means predictable cash flows. About 99% of its assets are regulated, which minimizes risk even in economic downturns. Fortis is also investing heavily in clean energy, with plans to spend $25 billion by 2029 on infrastructure upgrades and renewables. The stock's PE ratio is around 19, which is fair for a utility with such a strong track record. It's not flashy, and that's why it's overlooked. But for long-term investors, Fortis is a set-it-and-forget-it kind of stock. Let's move on to an ETF that's a hidden dividend star for many. ETF number 1, Schwab US Dividend Equity ETF, SCHD. Now, let's switch gears to ETFs, starting with the Schwab US Dividend Equity ETF, ticker SCHD. This ETF is a favorite among dividend enthusiasts, but doesn't get the mainstream buzz of, say, the SPY. With over $65 billion in assets, SCHD tracks an index of 100 U.S. companies with strong fundamentals and consistent dividend payments. Its yield is around 3.5%, and its expense ratio is a dirt-cheap 0.06%. That's just $6 annually for every $10,000 invested. Top holdings include names like PepsiCo and Cisco, but it avoids overexposure to any single sector, with a balanced mix of financials, tech, and consumer staples. What makes SCHD stand out is its focus on companies with high return on equity and low debt, ensuring dividend sustainability. Since its inception in 2011, SCHD has delivered total returns of about 12% annually, outpacing many peers. It's perfect for investors who want diversification without sacrificing yield. If you're finding value in these insights, hit that subscribe button for Trade Savvy Academy to stay in the loop. Up next, another ETF that's a dividend dynamo, but rarely makes headlines. ETF number 2, WisdomTree US Small Cap Dividend ETF DES. Our second ETF is the WisdomTree US Small Cap Dividend ETF, ticker DES. Small cap stocks often get ignored in dividend conversations, but DES proves they shouldn't. With $1.9 billion in assets, DES holds about 600 small cap US companies that pay dividends, offering a yield of around 4%. Its expense ratio is 0.38%, which is reasonable for the small cap space. What's unique about DES is its weighting strategy. It emphasizes companies with higher expected dividends, which tilts it toward value stocks with strong fundamentals. Top sectors include financials and industrials, but it's well diversified to reduce risk. Since 2006, DES has delivered steady returns, averaging about 9% annually, with less volatility than broader small-cap indices like the Russell 2000. Small caps can offer growth potential alongside dividends, making DES a great pick for long-term investors looking for both income and upside. It's not as sexy as tech-heavy ETFs, but that's why it's a hidden gem. Let's move to a stock that's been paying dividends for over a century. Stock number 3, Stanley Black & Decker SWK. Next up is Stanley Black & Decker, ticker SWK, a name you might recognize from your toolbox, but not your portfolio. This industrial giant has paid dividends for an incredible 148 years and raised them for 57 consecutive years, making it a dividend king. Its current yield is around 3.3%, and with a payout ratio of about 50%, there's plenty of room for future increases. Stanley Black & Decker makes tools, hardware, and industrial equipment, serving everyone from DIYers to major construction firms. Despite some challenges from supply chain issues, the company's global brand portfolio and focus on innovation keep it resilient. Its PE ratio is around 15, suggesting it's undervalued compared to the broader market. Why is it unheard of? It's in a boring sector, and recent volatility has scared off some investors. But for long-term holders, SWK's track record and diversified revenue streams make it a dividend rockstar. Our final stock is a healthcare play that's quietly delivering for dividend seekers, and right after, we will reveal the final ETF. Stock number 4, AbbVie Inc., ABBV. Rounding out our stock picks is AbbVie Inc., ticker ABBV, a pharmaceutical company that's often overshadowed by flashier biotech names. AbbVie has been paying dividends since its spin-off from Abbott Labs in 2013, with a yield of about 4.5% and a 52-year dividend increase streak when you include its predecessor. Known for drugs like Humira and Imbruvica, AbbVie generates massive free cash flow, over $18 billion annually, which supports its generous payouts. Its payout ratio is around 55%, leaving room for reinvestment and growth. The stock trades at a PE of about 14, making it a bargain in the healthcare sector. AbbVie's pipeline of new drugs and focus on immunology and oncology ensure long-term growth potential, even as Humira faces patent cliffs. It's not a household name like Pfizer, but its dividend reliability makes it a must-consider. Now, let's wrap up our list with a final ETF that's a dividend powerhouse. ETF number 3, Franklin U.S. Low Volatility High Dividend ETF LVHD. Our final pick is the Franklin U.S. Low Volatility High Dividend ETF, ticker LVHD. This ETF is a hidden gem for conservative investors, offering a yield of about 4% with an expense ratio of just 0.27%. LVHD tracks an index of large U.S. companies with high sustainable dividends and lower price volatility, making it ideal for those who want income without stomach-churning swings. With $1 billion in assets, it's smaller than SCHD, but punches above its weight. Top holdings include stalwarts like IBM and Verizon, spread across sectors like utilities, financials, and consumer staples. LVHD's focus on financial health, think high profitability and low debt, ensures its dividends are rock solid. Since its launch in 2015, LVHD has delivered steady returns of about 8% annually, with less downside risk than broader market ETFs. It's perfect for retirees or anyone prioritizing stability. Now, let's get to that bonus tip I promised. Bonus tip: dividend reinvestment strategy. Here's the bonus tip I teased at the start. Reinvest your dividends to supercharge your returns. By enrolling in a dividend reinvestment plan, DRIP, you can automatically use your dividends to buy more shares, compounding your wealth over time. For example, if you'd invested $10,000 in SCHD 10 years ago and reinvested dividends, you'd have about 30% more value today than if you'd taken the cash. Most brokerages offer DRIPs for free, and it's a hands-off way to grow your holdings. For our picks like Enbridge or LVHD, reinvesting can turn modest yields into significant long-term gains. The key is patience. Let time and compounding do the heavy lifting. 7 unheard-of dividend stocks and ETFs that can deliver steady income and growth for the long haul. Enbridge, Fortis, Stanley Black & Decker, AbbVie, SCHD, WisdomTree U.S. SmallCap Dividend ETF, and Franklin U.S. Low Volatility High Dividend ETF. These picks may not grab headlines, but their consistent payouts and undervalued potential make them perfect for building wealth quietly. Whether you're a retiree seeking income or a young investor planting seeds for the future, these are worth a serious look. And don't forget that bonus tip: reinvest those dividends to let compounding work its magic. If you found this video valuable, give it a thumbs up, share it with your friends, and subscribe to Trade Savvy Academy for more investing insights every week. Drop a comment below. Which of these picks are you adding to your watch list? Until next time, stay savvy and keep investing smart.